Good evening, everyone. I'm Rakhi Gautam from greytHR, the moderator for the session today. Thank you so much for taking out the time and joining us. Now, before I dive into the topic, let's do a little housekeeping on how the session goes. So, the session is divided in two parts. The first part will be the presentation by our expert, which will then be followed by an audience Q&A. Also, the session is currently being recorded. So, if you happen to miss out on anything, do not worry at all. We have got you covered. We will share this recording with you once it is available. And also, this session recording will be there on our official greytHR's YouTube channel under the playlist Parichay. So you can always go there and watch it later. Now, I already see a lot of people have joined us. So let's start the session. In this session today, we will be exploring the fundamentals of ESOPs and their growing importance in today's business landscape. Our expert speaker will delve into the benefits ESOPs offer to both employees as well as employers, along with key tax implications. We will also navigate the legal framework governing ESOPs and share insights into best practices for structuring them effectively. So, whether you are an HR professional, a business owner, or a finance expert, this webinar will definitely provide you with valuable takeaways to help you make informed decisions. Now, to decode all of that and to share his insights with us today, we are thrilled to have with us CS Bhanu Bhargava, founder and CEO at Provenience Group Companies. Let me quickly take you all through his profile. Bhanu is a seasoned company secretary and lawyer with over a decade of expertise in tax and legal consulting. He's the founder and CEO of Provenience Group, leading a team of professionals across offices in Noida and Gurgaon in India. As a mentor, he's empaneled with Google for startups in the Asia Pacific and has been a startup booster at 91 Springboard since 2016. Bhanu has advised various MNCs and serves as a legal advisor to brands like Bitbox Germany Group. He supports over 200 startups in India, offering guidance on tax, legal, labor law, and payroll compliance, and provides legal structuring advice for market entry in India, Singapore, and Dubai. Bhanu is also a speaker on professional platforms and also including ICSI chapters. So I think we have gotten the perfect person with us today. Thank you so much for taking out your time, Bhanu, for joining us.
Thank you, Rakhi, for the introduction. And a very good evening to the audience, to the greytHR family members. Today we have an opportunity to interact, particularly on a topic which is more relevant in the current times, which is about ESOPs and trying to test how tax and legal affects it. So, Rakhi, could I start with the sharing?
Definitely. While you do that, what I'm going to quickly do for our audience here is launch two polls, and we would urge each one of you to participate in this. This will help us understand, your perspective, your background, and also would be able to help us tailor our insights accordingly. So I'm going to launch the first question. I would request each one of you to participate. Is ESOPs implemented in your organization? You can choose yes, no, not aware. I must appreciate the participation that we are seeing. Within like 5 seconds, we already have 70% of you voted. But the rest 30% of you, please vote on this so that we can, make this session more insightful for you and more tailored towards your big background. Okay, so I see that most of you have ESOPs implemented, where it's like a 50-50% tie between yes, no. So that's for Bhanu to take forward. I'll just quickly launch another poll also to understand if your company is listed. So I'll end this poll now. Thank you so much, everybody, for participating in this. Let me quickly launch the second poll. Okay, so is your organization listed? Yes or no? Great participation, folks. Okay, so 80% of your organizations are not listed. Some 25, we have 22% of you listed. So thank you again for participating in these two polls. I will now hand over the session to Bhanu to take this forward and help us with all the great insights that you have in store for us. Over to you, Bhanu. Bhanu, you are on mute. If you could just unmute yourself and speak. Great.
Okay. I believe you're able to see my screen.
Yes.
Perfect. So, a very good evening, everyone. And the topic today, as I mentioned, we have is ESOPs to understand the tax and legal implications. Just for the audience, and since we have diverse answers in the poll, I'll surely start with the basics. The people who are already having ESOPs implemented or they're coming from listed companies should bear with me. Please bear with me. So I'll start with the basics of what is ESOPs and how do we see them as benefits. What are the benefits coming in to the organization? Now, so ESOPs, as the name suggests, which is about employee stock option plan or employee stock ownership plan, as we can call it, it provides a right or an option. It provides an opportunity to employee to gain ownership interest. So whenever the organization feels this, and every organization at some point of time would have this, that they should be having some benefits for the employees. And one of the benefits that they could provide out of the multiple other also is ESOPs. It's a right which is given, it's an option which is given to the employees to have shareholding to be a part of the cap table after a certain period of time. It gives a right to purchase shares of their employer's company at a predetermined price. Now, one of the characteristics is that there is a price which is set at the time of framing the scheme, at the time when you're starting the ESOP. It's usually the grant time, and which is obviously way lower. So if you see why ESOPs has been very popular is because of the commitment factor. Once the employee commits to an organization feels that there's a value addition going forward also, then the employee could have these ESOPs. And after a certain period of time, if there is a value addition, if the price of the company goes up, which is in value addition startups, which is a very common thing, they stand to benefit at that point of time. We see many examples, Paytm, Zomato, very recent Swiggy. I was talking to one of the people who are getting the ESOPs, and that is the right time for them to exercise. They've been giving this timeline. So the features of ESOPs, employee ownership, because after a certain period of time, the employee gets the ownership of the company, a part ownership after the ESOPs are finally converted. It has a vesting period. So ESOPs, it's not that the shares are given upfront. It's an option, as I mentioned. So it has a vesting period after which only the shares could be converted. So the vesting period is kind of a waiting period or a period after which you can convert the shares. Discounted exercise price, it's way lower than the market. It could not be lower than the par value, let's say 10 rupees in most companies. So it cannot be way lower than that. Alignment with the company goals, it's more about the employees seeking the alignment with what the company is, what the product or the services is. And they believe in it, they would want to go with the company in the longer run. And that is exactly how they benefit. Tax efficiency, it's efficient for employers, particularly the HRs like yourselves, wherein you could claim this as an expense. The ESOP portion is depicted as a CTC, is a part of the CTC, so it can be depicted as an expense at the time of claiming. Dividend and voting rights. The ESOP holders do not have the voting rights. They're not shareholders till the time they're actually converted. Retention tool, obviously the company. So it so happens that many a times for smaller companies, for startup companies, it happens that they're not able to afford the high salaries for employees. So generally what they do is they include ESOPs as a part of the CTC. which is why you could see higher CTCs going with ESOPs. So it acts as a retention tool as well, wherein the company is the employee is committed to the long-term motives of the company. Market competitiveness, it is, very recently, or in Corona times, you would have seen in the IT market, the salaries going way beyond what was expected, probably because of digitalization. And in the IT field, the components for CTC, the components for ESOP and CTCs were a major portion, what we've seen. So this helps the companies to be more competitive. This helps the companies to include the ESOP portion and have a higher CTC depicted to the employees. Performance-based vesting. So it's more of a structured arrangement that can happen. So shares could come to the employees, let's say, basis a time period, basis a performance also, which is more of an interaction between the employee and the employers. Liquidity options to private companies. I will discuss this at the end of the session, the presentation, which are more about what all options are available to the people, the employees who are having now the shares after the excise, and what all options are available. So once the ESOPs are granted to the employee after a certain period of time, which would not be less than 1 year, it could be vested, and then you can exercise those options. What are the options available to sell those shares? We will discuss them later. Benefits of ESOPs to employer and employee. I'll just go through acquiring, for the employer, it's acquiring top talent, increase in employee ownership, and employee retention. And for the employee, it's wealth creation. We've seen people even plan their retirement funds because of ESOPs. We have ownership and belongingness, which is we've seen that whenever in any company, when you are associated with a long period of time, and you would want you're having those ESOPs and you are having that ownership feeling, the performance is always affected. That is in a positive way, obviously. And obviously, the retirement plan, wherein there is a huge compensation, which is at the time of the conversion. So it could also act as a retirement plan for certain employees. Important terms. There are certain terms which I would surely mention them, but just for the purpose of mentioning them right now, in the beginning, like I'll be using the terms like ESOP pool, grant, vesting, exercise, which we've already discussed, excise date, period, and spread. So I'll explain them as we go. Legal framework governing ESOPs. What all needs to be read about ESOPs? Let's start from the flow. ESOP starts with finalization of the ESOP scheme or a discussion about benefiting employees. See, there are many other benefits also which could be clubbed or which could be said when we are talking about benefits to employees. We have ESPS, we have SARS, we have other modes also which are available. But ESOPs provide a very structured route which is available, and a more of a defined route, which is it's nothing that has not been there in India. The listing guidelines and the other provisions already have these provisions in place for ESOPs. It's just that in the last, I think, 5-7 years, been more popular. It starts with the finalization of ESOP scheme, which is the company can offer shares through employee stock option to their employees through an ESOP scheme duly approved by the shareholders of the company. So it's a process which we will surely, in the next slide, we'll go through, which is about how the scheme is kept in front of the shareholders, and the approval happens. And once the company agrees, it floats out and does the required filing to the MCA for structuring those ESOPs. Granting the option. So once the scheme is freezed out, we are now establishing the numbers about what options are to be granted, to whom it is granted. In terms of the micro matter of things, when an employee is given an option, at that point of time, and he opts for it, that is called the grant of option. Means a right is given to an employee to buy a certain number of shares, the company at a fixed predetermined price, over a period of time. So everything is mentioned in the grant letter, which is about which mentions the how much ESOPs are there, what's the time frame, and the other terms and conditions are there. Vesting of option, as we've already mentioned about the time frame, which could be which is for specifically examining each other. So there could be a couple of between a cliff period and a vesting option. Both of them are used simultaneously, and obviously one after the other, wherein a cliff could be exercised where nothing, the employee does not get anything until a certain period of time. Investing option is specifically to test each other that what benefit each other could bring up as an employer-employee. Eligible employees are required to complete a specific period with the company, as mentioned in the scheme of ESOP, to claim the benefit of ESOP. This period is called the vesting period. As per the law, there shall be a minimum period of 1 year between the grant and the vesting. Exercise right, which is after the vesting has happened, after the time period has been completed, the exercise after the completion of the vesting period, the employees become eligible to purchase the specified number of shares for the company at predetermined price. The action of paying the exercise price and converting option into shares for exercise of right. So this is the entire scheme of ESOP. There are multiple things that happen even after the right is exercised, how it is managed. So we'll discuss it at a later portion. Restriction on an option holder. What can I do? What can it not? There's no right to dividend or voting rights. It cannot be transferred, it cannot be pledged, hypothecated, mortgaged, or otherwise encumbered or alienated. Except in case of death cases, no person other than the employees to whom the option is granted shall be entitled to exercise the option, except in case of death, where all the options granted to him till date shall vest in the legal heirs or the nominee of the deceased employee. Legal framework also includes what are we talking about in terms of the different acts which are applicable and where do we deal. So I'm mentioning them because you would find some portions in some point of time, let's say you have definitions or you have some reference to, let's say in SBEB, which is SEBI share-based employee benefits and sweat equity regulations. So you will find a few things there. You may get a few things from LODR regulations. For unlisted companies, for private companies, Companies Act is more relevant. So I've just mentioned them for the sake of clarity. So we have Companies Act, we have SEBI regulation, share-based employee benefits and sweat equity, SEBI listing obligations and disclosure requirements, regulations from 15, and obviously the Foreign Exchange Management Act 1999. Whenever there is a foreign entity involved or the employee goes overseas, then we have to check about the FEMA guidelines also. Starting with the definitions and trying to ascertain who is actually an employee, because some time back, even the definition of employee or a sub clause of an employee was changed by SEBI. So we'll just check for it. Legally, employee means a permanent employee of the company who was working in India or outside India, director of the company, or an employee as defined in clause A to B of the A or B above of a subsidiary company in India or outside India, or of a holding company of the company, but does not include an employee who is a promoter or person belonging to the promoter group. So there's a definition specifically who is a promoter and also about the promoter group. And also a director who either himself or through his relative or through any body corporate directly or indirectly holds more than 10% of the outstanding equity share of the company. So both of them cannot form a part of the term employee. However, there is a exemption. The above two restrictions shall not apply to a company having DPIIT registration, startup registration for up to 10 years from the date of incorporation. And then we have, as I was mentioning about the word promoter, it is defined. So why is promoter important is because promoters are people who start the company. There are other legal aspects also. It could happen that promoters would want more equity or more shares in the company, pursuant to, let's say, any corporate action or any requirement. So ESOPs is not available to them at that point of time. right? So if the registration for DPID is not available, so that is a condition which we need to watch out at that point of time. The word promoter, as it is defined, shall be under clause 6(9) of section 2 of the Act, shall be taken into account while determining the status of the employee, whether he is a promoter or not. And one of the categories is a person named as a promoter in the prospectus, a person identified as promoter in annual return, a person having direct or indirect control of the affairs of the company as a shareholder, director, otherwise, and a person in accordance to whose advice, directions, instruction the board of the company is accustomed to act. So generally a person who either being legally documented or a person who has an influence. So that is what we mean by promoter here. Now, term permanent employee, as in the previous slide I mentioned about employee, so it includes permanent employee. And the change which has been is that however we do not find permanent employee, it has been defined in Companies Act, which is the principal act what we deal in. But SEBI has amended its regulation in its board meeting. And from 13 August 2021, we have a new definition which includes contractual employees, gig workers, and employees on probation or deputation that are eligible to receive benefits. The only condition is that they should be further designated as employees by the employers. So this is something which was a point of discussion at that point of time. Now, coming up to what are the different, while we start with ESOP, at a company level, how is it that the rules are framed out? How can a company get ESOP or may get its outstanding shares to be distributed to the employees? How is it possible? So we have two routes available, either direct route, wherein the company directly allows the shares. It's a simple process where the company issues stock options under ESOP to the identified eligible employees. And after successful vesting of the options, the employees get the right to exercise their options. So it is a directly interaction between the company and the employee, right? The entire process is the same. Now, when it comes to the second route, which is the trust route, which is the only difference is you create an entity which is doing the entire process in itself. So trust acts as an intermediary between the employer and the employee, and the entire process is handled by the trust. Wherever employee accepts, it's under this process, separate entities to be created, which is called employee welfare trust, and this trust acts as an intermediary between the company and the employees. Whenever employee exercises the option, the trust transfers the shares to the concerned employee who has exercised this option. So only difference is about creation of a trust. The rest of the requirements remain the same. However, there are requirements which relates to trust, who can be trustee, how the process happens to a trust. So there could be different regulations around it, but the basic process which we have discussed remains the same. Available routes to issue shares to the employees under ESOPs. Now, as we have discussed previously about the two modes, we are talking about either the trust route or the direct route. Under the trust route, existing shares or fresh issue of shares both can happen. Now, the decision making can happen basis the quantum of ESOP, basis how much elaborate it is, either direct or to go for a direct or a trust route. Provided that if the scheme is to be implemented through a trust, the same needs to be decided upfront. And also, if the trust involves secondary market acquisition, if you're taking shares from the market, in such a case, acquisition limit is 2% of the paid up capital in the financial year, and overall limit is 5% at any point of time. If trust acquires shares directly from the company, there's no limit of acquisition because the trust. So it is assumed that when we are creating a trust for ESOP, it is more of a elaborate process. If trust acquires shares directly from the company, then there is a set process for it. There is no limit for acquisition as well. A person shall not be appointed as trustee. So there are a few guidelines around it to hold shares if he's a director, a KMP, or a promoter of the company or holding subsidiary. So certain restrictions about people who are in the first circle, as we say. Beneficially owns 10% or more of the paid up capital of the company. So that is also one of the case. In case of unlisted, now talking about the process, how it happens, I've tried to brief that as much as possible I'll just skim through it. I have for unlisted companies and listed companies, the additional ones. I'll just skim through it. I know that's only for the purpose of mentioning it right of now. Once the scheme is approved, which is where everything starts, or the trust is created at that point of time, the filings are done with the ROC. The approvals are happening. Approval for board for granting of options happen. The filing happened with the ROC from PS3. So these are basic things that happen in any ESOP cases. There's then the issue of shares happen, issue of share certificates once the allotment happens. That is at a later point of time. This is for majorly from the Companies Act point of view. Now, when we come to the SEBI regulations, we have additional compliances, let's say for creation of a nomination and remuneration committee, obtaining valuation report, obtaining certificates from the merchant banker. So merchant banker essentially keeps a check on the entire set of activities. There are external certifications required. So, and also intimations, let's say for merchant banker, for secretarial auditor, intimations that need to be into the stock exchange. So this is a brief of what all needs to be done at the time when the ESOP is framed and at the time when the options are granted and also exercised. Just to mention, because I'm trying to take care of the time as well. For the cross-border arrangement, so let's say we have employees overseas, or you have holding subsidiary relationship, which happens a lot. If a company grants ESOP to its foreign employees, it has to comply with the FEMA guideline. ESOP to Bangladesh, Pakistan citizens are subject to prior government approval. So you need to take care of the recent guidelines also, which is about Press Note 3. Wherein which mentions about employees who are working in land sharing borders, countries like Pakistan, Bhutan, China, Taiwan, Nepal. So all of them, they need to specifically get approval from RBI. Reporting that are required to be made for ESOPs at the time of granting of options. I think this needs to be highlighted. It's the granting of options, and also the time from FCGPI is filed, the time of allocation of shares pursuant to the exercise of options. So grant and exercise both are a reporting point. Liquidity event scenarios. Now we have run through the entire scenario, starting from the grant to the exercise. But at the point of exercise, what are the options which are available for liquidation? Right, it could be ESOP surrender. Employees who choose to surrender their vested ESOPs back to the company. Straightforward process wherein the forfeiture happens. ESOP exercise, when you actually exercise the options. Secondary share transfer. Employees who sell their options or existing shares, to sell their existing shares. This method provides liquidity. Now, secondary shares, I'll discuss this later on as well. There are multiple options which are available, right? Because there's a tax point involved in it at a certain point of time, particularly at 2 points. When you are exercising your option, there is a tax liability. So secondary share transfer acts as a relief at that point of time. And also secondary share transfer acts as a relief at the time of when you're actually selling it. ESOP buyback. So the companies can buy back the vested ESOPs from employees, providing them with liquidity. This method is often used when the company has sufficient funds to repurchase the shares. We have seen ESOP buybacks happen. IPOs. We can see the very recent one example for Swiggy, what is currently happening. When a company goes public through an IPO, it can provide a significant liquidity event for employees holding ESOPs. This is how the exit could happen at the time of exercise. Tax implication, I'll skim it through for how the taxation affects ESOPs both for employer and employee. This is important for all of us. It's at the time of, so I'll first say tax implication at the time of exercise of options is first. At the time of allotment of shares, any company responsible for paying salaries to employees shall deduct tax at the time of payment. So this is the first point of taxation. Whenever the allotment happens, then any company responsible for paying salaries or it needs to deduct the TDS, as we say. When an employee exercises the option, the difference between the FMV and the security as in date of exercise of option, the amount paid by the employee for such security is taxable as perquisite. Right? So it's perquisite at the time of when they are exercising, because that's a point where conversion happens from ESOPs, their options, to shares. They are getting the benefit, which, as per the income tax, which the government says, you do not have anything in hand. Now you're getting the shares in your hand, and the cost of acquisition was actually nil, almost nil, or very minuscule at that point of time. And even at the time of calculation, you are making a good profit. So it's a perquisite and it's taxable. The fair market value of the security on the date of allotment is not relevant. It's mostly at the time of exercising. So exercise at the time we are exercising the options, the fair market value at that point of time is relevant. So this is important in case of listed companies also, and whenever we do foreign listed valuation also. What is the time frame? What is the exact point of time when we calculate which closing day price would we calculate for computing the tax? So fair market value security at the time of exercising the option is considered. Tax implication at the time of transfer by the employee. So we are talking about the employee already has the shares. He has already paid the tax. It's already been deducted. Now, how about the tax implication at the time of share transfer, when he's transferring the shares, selling the shares? When securities allotted in the ESOPs are subsequently transferred by the employee, the gains arising thereon, those are taxable under the head capital gains. Right? The period of holding of securities is also to be checked, because when we are computing capital gains, we have to check what is the time frame of holding securities. The fair market value of security on the date of exercising options shall be taken as the cost of acquisition of such security for the computation of capital gain. So these are two points where the tax liability arises for the employees. The assistance which is available, I'll discuss that in the subsequent slides. Example, suppose the employee is allotted 100 shares in an ESOP scheme at a concessional rate of 10 per share. The fair market value of the shares on the date of exercising options 50. So allotted 100 ESOPs, the total that comes out as a perquisite value is 50 minus 10 multiplied by the perquisite, which is 100, 4,000. So it's actually the perquisite value which is there. So 5,000 was the total minus what is available now. The perquisite value comes out to be 4,000 in this example. So which should give you an idea that the taxability is what the difference is when it comes to the price difference between once the company had granted the options versus when it is actually exercised. Tax benefits to business, since the ESOP is treated as an employee compensation expense. These expenses are fully deductible for business. They can claim it as an expense. This reduces the overall profit of the company and reduces tax burden of the company. Something of you just touching upon the points for the TDS reductions. So the provision for the reduction on ESOP perquisites on recognized startups. So there's the kind of startups who have the 80 ISE, which is not easy to get. To defer the deduction of TDS on ESOP perquisite for the employee. So there are certain conditions on where you can defer this. The first point of taxability, as you were discussing, that can be deferred. So what are those timelines? The provision outlines 3 specific events that trigger the timing of TDS deduction. The earliest of those events determines the timeline for tax payment. So completion of 60 months from the end of the relevant financial year in which ESOP shares are allotted, and date of ESOP or strategically shared by the employee, date of sale of ESOP, and date of cessation of employment by the employee with the relevant startup. So any one of the earliest of these 3, completion of 5 years, date of sale of ESOP, either you sell them or leaving the company. So the earliest of 3 will be a point where you can, which is a specific event that triggers the TDS reduction. Accounting treatment, I think it's not much of relevant for us, but yes, accounting comes into place when the first vesting happens. So it's not at the grant, it's not at the initial stage. It's more about the vesting that happens. The vesting and the exercise are the more chargeable options on tax. Best practices in structuring ESOPs. Now, while we have been doing this ESOPs, there are certain things which we understand, we recognize that having these things in mind helps you to structure a good ESOP policy, uh, um, intimate employees, let the employees know and let them be educated about what are their rights and responsibilities when they're holding ESOPs. It actually, obviously do not want to spoil the fun of having the ESOPs by not giving them clarity. So certain best practices, what we can exercise while we're talking about ESOPs. So let's say having defined clear objectives. What is the objective of having the ESOP policy? Is it talent retention, motivation, and also to align yourself with the fact that this is what we need to do, because there are multiple options available, ESOPs, ESPS, and the others are available to you. How you want to put up ESOPs as an employee benefit policy, eligibility and participation criteria. So since this is contractual, all of this can be structured. So specification about eligibility based on role, is it role, is it, because it can be role, because you can have a tiered ESOP policy also, like for a certain, it's relevant for a certain role or a decision making person. Tenure or performance. So this is a major decision making which happens whether you're going to do it for, let's say, year wise, or you're going to do it performance wise, a milestone. So this should be very clear, and this should be specifically mentioned to them. Structured vesting schedule to implement a clear vesting period, usually between 3 to 5 years. So there is a huge gap between the understanding the companies could have as low as a year or so as the vesting schedule. And sorry, for the exercise time. For the vesting schedule, it's more of structured between 2 to 3 or 4 years. That's what we have seen usually. And having a cliff or not having a cliff is also an important factor. Where it's a time period where you do not share anything, if at all a cliff vesting happens. So let's say an employee who you have a cliff of the first year, and there's nothing to be, which actually means nothing to be shared, and the employee leaves within the first year, so he does not get anything, and the vesting obviously has not started yet. So implement a clear vesting schedule, which is between 3 to 5 years, or graded vesting can also do. Fair excise price and expiry. We're mentioning it fair because something which I was mentioning earlier. Fair expiry and price is important because it shows your genuineness that you want to reward your employee. So the excise price flows to market value to provide genuine financial incentives and to define a time frame for excising options. Comprehensive exit and buyback policies, which is actually a very good thing. And I will cover that in the subsequent slide, which is about what all we could do, what are the options available at the time of exit. So, previously it used to be considered that having an ESOPs for a startup or a small company is actually worthless. I even know certain cases where ESOP have been granted, they're being converted, but they're not sellable. So it does not make sense to have ESOP policies or ESOPs if at all the company is not helping them. There are multiple avenues available, which we'll surely discuss. Outline vested and unvested shares upon resignation, termination, retirement. So clear bifurcation of what happens in these scenarios. Establish a buyback option for vested shares to streamline ownership transition when employee leaves. Understanding tax timing, as you've been discussing, the 2 points at the time when the options are exercised and the shares are sold. So generally, what we have seen is employees are they are very confident, and they're very much they take pride about their holding ESOPs. But getting to know about the structure of ESOPs, getting to know about when there will be taxation,
having a surprise at the time of payment of tax at the time of exercise is something which is surely you will not be glad to have. So that is something understanding the tax timing and then providing an option. That's a good thing to do. Deferred tax payment for eligible startups, the tax on ESOP, as we have mentioned previously. So if at all there's an exemption available, so the tax payment can be deferred. Consider performance-based vesting. For senior position, performance-based vesting could also be there, which is to create alignment between the individual companies, individual contribution and company goals. Legal safeguards and plain language. This is something what we try to do. We as plain language as we can use, but we are also structured. So ensuring agreements are legally sound, following corporate employment and security laws, use clear language. Regular communication and transparency, that's part of having a plain language and legal safeguards. Clarity on dividends and voting rights. So obviously, I think that's pretty much cleared at the time of grant of options. So that voting rights are available. Voting rights are not available at that point of time till the time exercise happens. Post-termination exercise period, the activities that happen after the termination, what all are the options available? So let's say the exercise does not happen and the termination happens. So what all cases are provided at that point of time? Clarity on corporate events, how each and every events, merger, acquisition, IPOs, the effect that's also to be mentioned. Restriction on transferability, you cannot transfer the options, you can transfer the shares. That should be there mentioned to them. Define lock-in periods. Asha. So lock-in periods, it's once you have the shares, you cannot sell them. That's a condition that is being put by the company as a kind of a lock-in period, so that even after it's vested for, let's say, 1 year, 2 years, and you exercise the options after that, but still you cannot do anything till the time the lock-in period is completed. So usually companies could keep, which is completely contractual, which companies could keep around a year or two for lock-in. The only logic for lock-in is to extend the time frame for selling the shares, is to keep the employee engaged, as well as a kind of a cap table management as well, which happens. The companies also vary about that the shares of the company are going in the hands of the third party. So that's something also they would want to see. Separate ESOPs for different levels. Utilize capital gains exemptions. So we have capital gains exemption for from income tax, which is under section 54F. Reducing the tax liability, which has recently been some time back, it has been the maximum reduction has been capped at 10 crores. Extended excise period. So there's no limitation which is mentioned in the act. They could be very flexible about having the excise period. Disclosure of, so all of these things, they do help employees to actually have the joy of having these tools, rather than making it more structured or making them more tricky for the employees. Implementation of an ESOPs trustee. For companies with larger ESOP pools, appointing an ESOP trustee can help manage the plan, facilitate share transaction, and oversee compliance with ESOP policies. As we mentioned previously, that either you can go for a direct route or a trust route. With larger ESOP pools or larger ESOP events, you have a trustee in place which takes care of everything. So that those policies and how the interactions should be also be there. Automation of ESOP management, which is something very a delight for the employees. We can use specialized software for tracking vesting schedules, excise dates, and tax reporting to simplify ESOP administration. So there are many softwares available in the market. You could surely refer them as a part of the ESOP management. However, I wanted to talk more about the best practices, one of which is about cashless and funding option in ESOPs. How can, once the ESOP has finally completed its vesting, at the time of exercise or at the time when we wanted to sell the shares, how can we be helped? So so cashless option. The cashless option, employees exercise their option without any cash outflow by selling a portion of the share. You sell the portion of your share to cover for the acquisition cost and taxes, right? So this is the kind of a way to help out ease the tax of the cash flow in particular. Method is convenient as it eliminates the need for employees to arrange funds upfront. We've also seen cases where the employee let go of the ESOPs just because there is a huge tax outflow, right? Funding where a third party comes in to fund the tax portion at that point of time. So, I mean, kind of a loan which is being given. While in funding option, employee receive funding from the company or third party lenders to cover the exercise cost and taxes. Both methods aim to make ESOP participation more accessible and less financially burdensome for the employees. The choice between cashless and ESOP funding depends on the company's policy and employees' financial preferences. There's also we've seen unlisted marketplace for an ESOP. So ESOP shares. We are mentioning about shares, not ESOPs very specifically. Unlisted marketplace for employee stock option plan provide a platform for employees of unlisted companies to buy and sell their stock option. These platforms are crucial for providing liquidity to employees who hold ESOPs in companies which are not publicly traded. These platforms, like one example is unlisted card that allows employees to trade their ESOP shares and PIPO shares. Another unlisted shares. It offers a trusted environment and partnerships with major banks and financial institutions. So many examples that you have, wherein the entire journey of the ESOP, starting from once it is granted to when it is vested, till the time it is exercised. After the exercise happens, how it can be sold. So all of them, that entire life cycle could be automated. So that's in very brief that I tried to sum up the ESOP topic for tax and legal pointers. And I would invite all of you to for your questions. Raki sure could help me out in this.
Thank you so much, Bhanu, once again for that insightful presentation that you did. Very comprehensive, and I'm sure there was a lot to soak in, and people would be still soaking all the insights that you shared. But one great thing is that this is a recording, so in case you want to revisit anything at any given point of time, you can go and watch it later. So what we will do, I already see some questions lined up. There is one question that is currently visible to me. I'll just read out that question, and then everybody, you could start putting across your questions now. And we have with Bhanu, we also have Mr. Vivek Jain and Ms. Raksha Saxena available with us to help with your queries. So let me just quickly start with the first question, which is, what happens to employer if vested amount not paid to employee at the time of exit? Also, is it taxable under salary 192B?
Yeah, so that has been mentioned that. Okay, should I just stop this slideshow here?
That's okay, yeah.
Okay, so the portion of the ESOPs that you let go or lapse, they are, I mean, nothing can happen for that. That goes to the kitty of the employer, and you've neither exercised them and you've left them. So it could be, let's say, because of the taxes. Or probably other issues, but those lapse and the benefit does not go to the employee.
Okay, thank you for that. I hope that answers the question for you. Moving on to the next question, which is, if company says ESOPs worth 20 lakh, is it misleading and how?
So that's probably a question for the time of CTC. If they are worth 20 lakhs. So you need to just check out what's the current status of the company and how the 20 lakhs is computed. Is it the future value or the projected value that you need to check? I would not say 20 lakhs is misleading. It depends on the company. But how is the 20 lakhs that you need to check?
Okay. Thank you for that. Moving on to next question. There are some queries related to the PPT. So this is a recording, and this will be, when you watch the recording, this PPT will be available on your screens. So that is how it will be shared with you. But of course, if there's any specific questions on which you would want to connect with Bhanu, we will be sharing his credentials with you, and it's still available on your screen right now. And you can take it offline as well. Okay, moving on to next question. There's a question from Hiral. When meaning companies should be old enough to give ESOPs to employees after how many years from inception?
That's entirely on the company. There is no yardstick to have that. But consider that situation wherein the employees, wherein the company, let's say a startup company, for example, they would want to hire employees, or an example of COVID, as I was mentioning, skyrocketing salaries, right? So at that point of time, you have no other option just to include your ESOPs also, which is obviously a commitment from the employees. I have been witnessing a lot of interactions with IT companies where the employee come up on board just because they love the product, but they're not getting remunerated well. But since ESOP are also part of the overall CTC, which is why they have come up. Now, as I said, there's no particular yardstick, but yes, these instances should give you an insight about when is the right time. It could be startup companies, it could be even a larger company, but the employee interest is a paramount factor. The employee joy is a paramount factor.
Got it. Thank you. There's a follow-up question to this as to how to show this in CTC. Any fixed percentage calculations, if you can guide, please.
No, so that is part of the CTC. See, CTC itself is not a I'll say it's not that of a legal term. What we use we use generally. So if it is included in CTC, referring to the first question, I'll not say that that's a trick one. That's part of how employees frame up their compensation packages.
Okay. Next question is, how can I cash out the ESOPs after the vesting period is complete?
Yeah, so that is exactly what exercise is, right? And the options which I mentioned, if I could just reflect back on the slide which I mentioned previously. Yeah, so either you can surrender them. So surrender is one thing you would not want to. You're talking about how you're going to exercise them. So you can exercise the options, the time. So there's a time gap. The time window is intimated by the company. And either you could, once you exercise them, you can sell them. Then there are other options, let's say for cashing it out, as I mentioned there, cashless or the funding option which are available, so just to fund your tax portion. So that can also be there. And ESOP buyback or IPO. So these are more of corporate actions that happen, not particularly planned at such advanced stage. At the time when you have the ESOPs, the time frame being decided for the exercise to happen, that is the time frame that you can do that. You should be very cautious about this time frame, because if you miss this, the ESOPs will lapse.
Thank you for that. Next question. This is like a rapid fire round that we are doing because there are a lot of questions coming in. So I'll just quickly hop into the next question, which is from Devi Madireddy. When the company is not a listed company, how the employee will get to know the actual value of the given stock options?
See, then you need to refer the valuations then. See, if you're only talking about the value, firstly, at what stage is it about? Are you in the vesting stage? Then there is no point in talking about what are they worth. But when you come up to very closer to exercise options, then you need to ascertain what stage the company is. And then you need to talk about how you're going to exit. What is the plan that the company has given you? And how can you opt for those options which are given by the company, particularly the exercise time, what are the current market price? To answer your question, it is the previous valuation that you can check for a startup company. It so happens that the valuations happens probably every year or every second year, what we've seen in the funding round. So you can refer to those.
Thank you for that. I hope that answers the question for you, Devi. Next question is, we are a US-based subsidiary with a parent company holding a 99% share. All employee ESOPs are allocated by the parent company. When an employee exercises their options, what FMA should be considered given that the company is not publicly listed in India? More about the tax liability payable by the employee.
Right. So, this is a very good question, and I wanted to speak about this particular scenario. Not only this, see, this is the most seen scenario where you have parent company and you have ESOPs for the parent company and not for the company in India. So, in IT companies, it happens a lot, wherein you have the parent company having their outsourcing center or their research center in India, but the attractiveness of the Indian company might not be there, right? So it is mostly about the parent company. Now, it is about the residential status. It is about your residential status, and since you're talking about the parent company, this they are the factors change. Let's say for the factors are different. Let's say for Indian employer, they can claim expenses. They can there's there. I mean, for the TDS portion, there is they have to deduct the TDS at the time of exercise. From the employee, it is taxable at the hand of employee as a global income, rather than at the time of the ITR filing that you need to specifically mention that this is my income from the sale of shares. If you have not exercised it, you have to mention them as assets in your returns. So that is that you need to take care. The only thing that changes is how you report that to the government. The only thing that changes is how you when you liquidate those assets, you report them to the government as and you pay that taxes.
Okay. Thank you for that. Next question is from Parameshwara. What happens when the company is not listed and the employer grants ESOP to employees? How does this benefit employee, and if employee can sell those shares?
I've already covered that in the features, and which are more about the benefits of ESOPs. So I'll not repeat the answer then.
Sure, you could. Maybe this question was asked previously, but you can watch the recording and you'll find the response there. There's a comment from Srinivas Murthy, very informative, and thanks for arranging it. So thank you, Bhanu, and thank you, Srinivas, for being a part of this session today. There's another question from Dharmendranan. Is there any buyback option available for unlisted company?
Yeah, so the companies that provide for the buyback options, which can be done. See, that's company's own policy. Whenever the company plans to do a buyback, the objective is just to have more of share capital in hand. And as I mentioned in the presentation, also it's about the company having cash flows available. So at that point of time, it can do a buyback. These are the instances which triggers a buyback, and that's very company specific.
Okay. Next question is from Subhash Shetty. How can we do exercise if company not moved IPO, or is there any chance to get the benefit from that?
Yeah, so that is that I answered in the last question, which is about just to share it once again, which was about the options which are available to the public, to the employees who are having those ESOPs. Either they sell it in the secondary options, or there are other platforms also available, which automates, like unlisted card, which I mentioned. And you could refer to those platforms, how they can help you out to get an exit. ESOPs, till the time they are converted, obviously they're not tradable. You cannot do anything out of it. Once they're converted, then you can see how that can be converted. That can be sold.
Okay. Next question is you can check if this is something that you can take up, but let's see. For senior roles, how much percentage of CTC should be ESOPs? Let's say 25% of fixed components. This question is to understand industry benchmark across D2C companies.
Very varied, very much varied. See, ESOP, we have seen companies even start with 7%, 10% of the ESOP, because that's nothing which is being fixed, but 15%, 20% also. ESOP, if at all you think from an investor perspective also, This is not something very much included in the presentation, but from the investor perspective, they would obviously want the ESOPs to be there in the cap table. Reason being, let's say anything untoward happens to the promoters, or the main founder of the company, there needs to be somebody technical available, right? So that is something that you need to keep a track of and bear in mind. Percentage, whether at a senior role or at a going forward, that's dependent on the company's policy, which is drafted, ESOP policy, which is being drafted. So at that point of time, it is mentioned that how much the pool is created, how much is given to a particular employee. That's something which is mentioned in the grant letter and the agreement.
Okay. Next question is from Meghanathan. Parent company has ESOPs, but subsidiary does not have, but they agree to pay as phantom stock. Kindly advise tax liability on this.
So there was a concerned question, there was a connected question about what are the other options which are available. See, phantom stock, you do not get the stocks, you get the benefits out of it, right? But while we're discussing this, I must also mention what other options are also available. So it's not only the phantom stocks, it could be SARs also, right? It could be ESPS also. So getting to know what is the benefit as well as when are you getting the ownership out of it is very important. So out of all the instrument what you may have, the ownership is one thing, and the benefit that you get could be deferred. Like for example, in ESOPs, what we discussed, you do not get the ownership right away. You get you do not get even the benefit right away. You get it after the vesting period. You get after the excise period is completed. So that is when you get this. Now, for the taxability, I think it remains the same, barring the fact you do not get these shares with you. If you're an Indian resident, the applicable tax liability does not change, because that will be actually your capital gains.
Okay. I hope that answers the question for you, attendee. Next, moving on to the question from Monica. Wanted to understand that once the ESOP is granted to the employee with approval of shareholders, do we have to receive approval of board for vesting again?
I need to check this, but I don't think so.
Okay. Monica, we would, connect you separately also offline with Bhanu, and maybe you could share more background to this, and we can get you the response that you're looking for. Moving on to the next question, which is what is non-tax favored option and how is it different from ESOPs? Are they similar, or what are the differences?
So there could be many of them. If the member could specify what all options he's talking about. So, I mean, what particular options we are talking about?
Sure. If you could please specify it, we would be happy to help you. The next question, I think we did cover it, but if you would just like to maybe touch upon on this one. This is from Krishnan. ESOP is fundamentally a retainer and a long-term benefit. Is it fair to show that as a compensation with CTC part, etc.?
As I mentioned, CTC is not that's a legal term. We mention it as the cost to company, which is more of a finance head. How is it? What's the per employee cost, which is there? So that is why it is mentioned. But if you see the practical application, it is being listed. It has been quoted out in the employee letters, right? Forming a part or not forming a part, that's on employees. I mean, I have so many HR heads, so I cannot say yes or no.
Okay, thank you for that. Moving on to the next question, which is, my employer is a subsidiary of US company. I've been given an option to exercise even the unvested shares in financial year 24-25 itself. Is this recognized under income tax law in India? Also, can I pay perquisite tax in India on all the shares exercised, or should it be only on the vested shares?
I wanted to take this. This is not only the one scenario. There could be a scenario wherein you have combinations of parent company being in India, parent company being in overseas. The residential status. See, in this question, the residential status is important. If you're in India, the reporting and the taxability falls in India. If you're in India, right? If at all you're overseas and your residential status has changed, then you need to report it there, right, and disclose it in the annual ITRs there. Right? A very plain and simple answer could be this. However, I specifically wanted, but it is just because of the time, we did not include. Our team members had specifically prepared this another section, which is about what all scenarios could be covered, basis the residential status. But we have not taken up in this slide. The answer to the question is depends on the reporting requirements for the particular tax authority. If you're in India, you should report that in India. If the entity is Indian entity, as you mentioned, so you need to disclose the assets there.
Sure. Thank you for that. And I think with this, we have covered almost all the questions. There is a feedback. So the attendee is saying he's a resident for this question.
So then if he's a resident, then he needs to not only, so the tax liability falls in India then.
Okay, great. Thank you, Bhanu, for the response. I hope that answers the question for you. Now, I think we have already covered all the questions. There are some feedback and some good feedback also, and some feedback on making the session more interactive. Definitely taken this feedback, Lavina. And as we are just noticing that there are some subtopics under ESOPs that you would want us to cover, and we'll definitely plan another session soon whenever we could with Mr. Bhanu here, and we'll be sharing the invite for that also. So with this, I think we have covered all the questions. Thank you so much, everybody, for participating, and thank you so much, Bhanu, for that comprehensive presentation and taking all the questions so patiently and answering. And it was a pleasure to host you today.
Thank you, Raki, and I must say it was a challenging task to complete all of this in 1 hour and try to delete a lot of things. I mean, in the past week we have deleted a lot of things just for the presentation, and I take the feedback, that it could have been more interactive. But to be honest, my effort and my team's effort was to brush up things to the audience and to mention the audience what all things are there. Particularly about the best practices, what we've been seeing in other companies also. There have been a tremendous effort from both of my teammates, CS Raksha and CA Vivek Jain. And so the presentation has been, there have been a lot of efforts from both of them for preparation of this. So thanks to them as well.
Thank you so much. And as we said that this was the first episode of this ESOP series that we could plan ahead, in the future. So we would definitely plan more episodes for our audience here. But thank you so much once again for being here with us today, and to all the attendees also. I'll just quickly launch one poll just to understand the audience feedback. If you found the session informative, and how would you rate the session? And we'll come back with another session very soon. But as I can see on the poll, there are good feedback that we are seeing here on the poll. So thank you so much, everybody. Once again, I'll just quickly share an update. Ankita, if you could please share our screen and show the presentation. Okay, so to most of you, you would be aware that we have our Grey Tribe community. It's a knowledge sharing platform where we have experts like Bhanu, payroll experts, HR leaders who you can connect with. It's a free of cost community where you can sign up and ask questions. So you can see the link below. Please feel free to sign up and have those conversations there. We are also available on WhatsApp. I would request the slide to be changed to WhatsApp. Yes, so here you can see the QR code. You could scan this QR code and connect with us on WhatsApp also. If there is any question related to greytHR or on our webinar series, you can connect with us there, and we would be happy to help you out. Also, as promised in the beginning, this session is recorded, and it will be shared with you all very soon, probably early next week. And we'll also be sharing Mr. Bhanu's credentials. So if you want to connect with him, you can do that. So thank you so much once again, everybody. But before I let you go, I also wanted to take a moment and announce our next webinar, which is on next Thursday. The topic is HR Tech and how to enhance your employee experience with HR Tech. I'm just putting the registration link in the chat bot. You could see, it would be visible to all of you. If you want to sign up for that webinar, register for that webinar, you can do that right now. or any questions other than this, any feedback that you have for us, please feel free to write to me on rakhigotham@greytip.com, and I'll get back to you. Thank you so much once again, everybody, for tuning in. And special thanks to Bhanu and his team for being here with us and sharing all the insights that you did.
Thank you to the team. Thank you.
Thank you so much, everybody. Have a great evening ahead.